The disclosure of information on corporate social responsibility is based on three essential pillars: environmental, social, and organizational governance. These parameters, which are produced by various rating agencies around the world, are now closely examined by stakeholders to assess the societal performance of organizations. Consumers, suppliers, and also investors are increasingly interested in the quality, the relevance of this information for considering a long-term commitment with companies. Studies conducted by European, American, and Canadian researchers show that investors have been particularly sensitive to environmental information for several years, and to a lesser extent, to corporate governance information. Typically, the quality of information disclosed about pollution, waste processing, environmental risk management, or even carbon impact has an influence on the financial performance of organizations, executive compensation, and the cost of financing for organizations. The environment is a major issue that concerns executives, as it is seen as a scarce resource. Investors are sensitive to environmental data because it allows them to better assess risks, and they are inclined to finance more environmentally friendly companies at a lower cost. On the other hand, quite surprisingly, the social pillar is absent from these considerations, as if the quality of information relating to employees and human performance currently has little impact on investor sensitivity. Some American authors have even put forward the idea that social mistreatment could lead to better financial performance with investors. Yet social rating agencies have provided multiple social criteria revolving around compensation, turnover rate, absenteeism, and also various employee reviews found on social networks. Nevertheless, human complexity is still not fully appreciated for its true value. It would be appropriate to invest more in criteria that are more complex but also richer, such as the quality of human capital, quality of life at work, employee well-being, and career prospects in terms of training, experience, and compensation. Composite. The specific human asset is an extremely rare resource that should be better understood, better measured, and better managed. It is therefore surprising to overlook employee compensation in the major debate on CSR. The current trend toward an employee dividend shows just how necessary it is to consider new connections between employee financial performance and company financial performance. Organizations that attract investors and offer composite compensation to employees, tailored to the challenges organizations face in the short, medium, and long term. The employee dividend also opens the door to other possibilities, such as making stock options widely available to employees. As a result, rating agencies will increasingly question companies using composite compensation criteria. This will allow for a better assessment of the value of employees and the human capital managed by organizations. In conclusion, the current lack of a meaningful link between information on social performance and the financial performance of organizations raises important questions. Yet it is indeed the wealth of human capital that will enable organizations to innovate and create value. It is also information about these links that will allow rating agencies to better inform investors about the influence of social factors on organizational performance. In this respect, information about value created and shared in a partnership sense should take precedence over information solely about value creation for shareholders.